edition of Big Picture, we will analyze the future of IPOs in India after a few massive IPOs have failed at the markets. Joining me on the program today are Jayant Das Gupta, former ambassador of India at the WTO, and Dr. Ajay Dua, former Commerce and Industry Secretary, Government of India. Thank you to both my guests for joining me on this edition of Big Picture. So, Dua, how would you look at this whole IPO scenario? You know, we had some massive ones come up a few months ago, but it was Paytm, Zomato, Nykaa, and a lot of, fanfare, and everyone seemed to have oversubscribed. Some of them, even more than 3 times. So that was that was the situation. But now, if you look at it, if you look at Zomato's share prices today, lower than even what the offer price was. What seems to be the problem? What has gone wrong?
Overvaluation of the values of their share. Actually, last I knew, it was the Paytm which had shrunk. It was trading at least till the day before 59% below the price at which it was offered. And many others, including the 2 which you named, out last year, I believe 59, in the last calendar year, 59 IPOs were floated. And by the end of the year, at least half of them were trading below par. The par means that they are the offer price. And of course, the highest drop was in the Paytm's price. So the 2 things, I would say, one, the valuation which was approved for them, because these valuations also have to be got approved from SEBI, were probably too high. The prospects, most of them really based themselves on the prospects, not on the current earnings, not on the current revenues. The classic case in that is Nykaa. That a company floated about 5 years ago, still the turnover is only about 2,500 crores annual, and then it manages to raise money at such high price, and probably 13 times the volume was the subscription for it. Second, I think the timing was wrong, because short-term bursts in the equity market should not really be guiding either the regulator or even the parties wanting to applicants for the IPOs. We are passing through pandemic. The world is passing through pandemic, and the recovery is certainly not complete. Europe may have recovered a little more, or Europe and the United States, but in India, we had seen till the end of December only certain green shoots. So absolutely, I would put these 3 as the factors.
So, Mr. Jayant Das Gupta, let me bring you in here. So, is it a reality check, so to speak, as far as the IPO mania in India is concerned?
I think I would list a few more factors. I agree entirely with Dr. Dua, but just to give some more perspective, there are a few more factors. One, that there was too much of money sloshing around, including in the hands of the foreign institutional investors. And they wanted to invest their money and get quick returns and then pull out. Now, that process has already started, because the US Fed has started tightening its easy money policy, and has been a pullout. So while the money was plentifully available, bank credit was available, but people were not availing themselves of it to make investments in real assets. This, after all, the IPOs are virtual assets. So that was one of the reasons why they were overpriced, and that was one of the reasons why I think the Indian share market also, if you look at the large cap and the medium cap shares, they all appreciated very heavily in the last 12 months or so. So that was one factor. The second factor was that there is always, as Dr. Dua mentioned, there is always this pricing based on expectations of profit. Now, if you look at these firms, many of these unicorns which were floated, which floated IPOs last year, in terms of real assets, it is basically the goodwill that they have and the kind of business they may generate in future, making certain assumptions. For instance, a food delivery system. Now, during the pandemic, a large number of young urban professionals, for instance, were cooped up in their homes. Of course, the household help was not available. So they were resorting more and more to placing orders on food delivery apps. Once the situation gets better, there is back to office kind of a routine established once again, there is bound to be a fall in the kind of profits these apps were making. So that is just one of the issues. So this valuation vis-a-vis, real asset-based companies and something which is a notional or virtual asset-based companies, basically about goodwill and expectations of profit based on certain assumptions, I think that went awry.
Absolutely.
So these are some of the primary reasons for the less than expected performance of 2 or 3 of these very large IPOs.
Absolutely. Mr. Dua, let me come back to you. So what does this mean for the future of IPOs in our country? Because, there are a raft of them that are in the pipeline. Some of them have even pushed back their public debut dates. Prime among them are Oyo and the logistics company Delhivery. So what does this mean for them?
I would totally share the views which Mr. Dasgupta just mentioned, that the prospects rather than the reality is the American way of doing things. And we seem to have got influenced by this considerably. If our pandemic continues forever, which it is not and which it should not, we all hope that it ends at the earliest, there is going to be much greater reality or realism dawning into the logistics companies, particularly the ones serving the last mile. Our overall logistic costs in India are high for exports, trading, etc. That we all understand. So many more people have, many more players have to come in. There has to be digitization there. There has to be faster clearances at the ports. Customs have to, kind of start playing ball, etc. All that's taken real. But if it is only grocery deliveries, if it is only food deliveries, that as soon as the pandemic comes back, recedes much faster than it has been, I think some of these companies would feel the pinch. That's number one point. Number two, I see the immediately letting people float IPOs is also an issue to be seen. Unless a startup has been able to establish itself as an ongoing business, it's no longer a startup, only then SEBI should allow money to be raised from the public, because IPO means equity, not debt. Everybody says my company is doing well, now let me float an IPO, then I don't have to return it. I'll keep the startup or anybody else, he withdraws his money and probably goes scot-free because now it is shared, the risk is now shared by thousands of investors. Having said that, I would also draw your attention to the fact that this, even when Reliance in the first time in the year 1977, when it used to be selling its products under the brand name Vimal, it came up with its IPO after it had set up a world-class textile, complete textile mill based on HDPE, polychemicals. Then it floated it. The World Bank gave it, and I still remember that. I was a junior officer in the industry ministry at that time as well. I remember seeing it. The World Bank's endorsement was used by Reliance about this plant, saying it's a world-class plant which they had set up. People trusted, people invested in it. So Reliance by then was at least 10 years old. So I think the startups by till then have to learn to kind of float in the waters which are not necessarily smooth. I'm not saying murky waters, but certainly they have to see the ups and downs of business, and till then survive on raising debt or through debts and self-contribution, rather than immediately hit the market just because they happen to be doing well at that point of time.
Absolutely. So let me take this particular aspect forward with you, Mr. Dasgupta, the role of the regulator really going forward, because clearly the last few months have shown us that many of these companies cannot do as expected, really, and the role of the regulator has to come in here. And what could be the role of the regulator going forward in ensuring that we don't see any more such complications coming up?
I think the regulator's role is really a very, very difficult one, especially, keeping the fact in mind that the trust of the investors depends a lot on the regulator's judgment about the price band in which the shares should sell. Now, as opposed to something like Reliance, which had real assets backing it, of course, there were projections about future sales, etc. The problem with present day companies, many of these unicorns, is that they don't have real assets. It is all about borrowing money, being in the red for the first few years or many years, and then making a projection that we will turn the corner and then suddenly we will get into a lot of profit from then on. Now, this period when they are in the red could go anywhere up to 5 years, 7 years, 8 years, 10 years also. So during this period, this is the problem. If they want to expand, and the usual lenders who have sunk in their money initially, they are no longer willing to take greater risk by lending larger sums of money. They say, please go public. This is the problem that is being faced, because with digital technology now available, very rapid expansion of business activities is possible. You need not build a factory, buy land, build a factory, start production, which may take 3 years, 5 years. You may expand, for instance, a cab hailing app. You may expand it to a new city or 20 new cities by just having, your software network become larger, and of course, getting more and more taxis under your wing. So it is not something which can wait. So this is the basic problem that the regulator will face. And with these virtual assets, the problem about valuing them very close to the real value is going to be a very difficult one. And many a times, I think the regulator will miss the mark by a wide margin. So ultimately, the investor will have to take a risk, will have to use his own sources of information, whatever has been disclosed, and his own judgment about the future of the business before investing.
Absolutely. All right, time to get closing comments from both my panelists now. But Mr. Dua, March 11th is a big day, really, as far as IPOs are concerned. The big one, LIC, is coming up. So, how would you look at that? And in the current situation, current scenario, is that going to be affected?
Before I do that, can I just comment on what was just said by Mr. Dasgupta? The IPOs is when the public at large is subscribing. I am not saying that a startup should not be allowed to raise money by equity, which is private equity. Private equity does not require a regulator's approval. The people who will invest in it, in the private equity of a startup or any other company, do their own due diligence and invest. Similarly, the banks which are giving debts, if the banks think that it should go and raise equity, the banks also have an option of saying that we are giving debt, but it is against warrants which are convertible, or which can convert the debt into equity. Whenever you decide to go into the market or give them a time limit, when it could be as private equity or it could even be as IPOs. That's a way out, and a number of companies around the world, people have been raising money for the startups in this manner. But going IPO certainly requires due diligence and people's trust in the regulator, that regulator has done his homework, and that is why he is recommending a particular share, he is recommending a particular price band for it. That was just to clarify, taking forward the argument which was made by Jayant. Now on the IPO for LIC, yes, but 5%. 5% is now, it was earlier supposed to be 10%, now it's brought down to 5%. It is much more, looks to me like testing waters. Because it's like 5%, by no stretch of imagination, we can call it as privatization. It is what should be the right price. The IPO will be approved by the regulator, and already LIC has said they will fix the price in the last 2 days, 48 hours or 72 hours. Before that, the LIC should do well because it has 65% of the market share of the insurance business in India. There are 24 private companies which share the remaining 35%. But the number of products which LIC offers is 250, which is large, very large product, and it has a huge agents, network of agents developed over the years, developed over generations. One father passes on to the son or to the daughter, and so these are its inherent strengths. But let's make sure that the price which is suggested, even if it's testing one, because the price to other day I was just calculating, it's at close to 3,000 rupees a share. Is that 3,000? Sorry, about 1,800 to 2,000 rupees a share is what it's going to be for this, a 10 rupee share. I think in good times, it would have certainly gone well. People would have taken it when the FIIs, FPIs were active in India. The money tightening situation which Jayant referred to of the Fed hadn't taken effect. But as of now, I wouldn't call it an IPO per se in a big manner. The government would kind of, it's after acquiring the experience, then only come up with the real price when the larger ones are offloaded. Larger share of it is offloaded.
Absolutely. And Mr. Das Gupta, close the show for us with your
I
concluding
think
remarks.
I think one of the reasons, of course, this is the prime reason that they want to test the waters. The government wants to test the waters. But there is another reason. That is, in order to bring the deficit down to 6.4%, some 78,000 crores will have to be raised before 31st of March. And out of that, only about 12,000, 13,000 crores has been raised. So the target is to raise another 60 to 65,000 crores by this IPO, because there is nothing else in sight at the moment. And that is why this, I think, 5% is being offered. Now, having said that, there are two indices which are used in the insurance business. One is the embedded value, and the other is the value of new business. On both these counts, LIC fares very well. There are about 29 crore shareholders and 13.5 lakh agents. And the trust in LIC, I was just looking at some of the figures. The LIC payment percentage is for policies, against policies, is much higher than that of the private insurers. That is one of the reasons why people of India have reposed their faith in the LIC time and time again. So I think, of course, the time is not opportune to float a very large IPO because of the tightening and of the money policy by the US and the withdrawal from by the FIIs. But 5%, which is about approximately $8 billion or slightly over that, I don't think there will be much of a problem. And this is basically, as they say, price discovery exercise.
Absolutely. All right, gentlemen, we'll have to leave it at that. Thank you so much for joining me on the program and putting things into perspective for us.